Hey folks, Chris Versace here. Welcome back to the Stocks and Markets podcast at The Street. This is the podcast where we talk about, well, you guessed it, stocks and markets and what's moving them. Joining me is a return guest, an old friend of mine, and someone who I collaborate with quite often with. I'm, of course, talking about Bob Lang, who does a great job at looking at the technicals for the Pro portfolio. And I'm happy to say that you can not only catch Bob's musings over at the Pro site, but you can increasingly catch him on a growing array of financial programming, whether it's Schwab, Yahoo Finance, or some of the other great shows that are out there. Bob, as always, my friend, a great conversation is about to be had. Thank you.
Great to be with you, Chris. And I'd be careful of using the phrase old. You called me an old friend. I'm not that old, Chris. I know I'm a little bit older than you, but I'm not that old.
Look, Bob, at the end of the day, all that matters is we've known each other for a long time, and you have more time on this planet than I do. Both qualify as old. I'm sticking with it.
Indeed. It's great to be with all of you today, talking a little bit about markets and trading. And the last time we were together, Chris, and there was a lot of volatility, a lot of market uncertainty, and volatility gets priced in as we talk about the VIX. And I don't want to jump ahead here, but certainly, we're having a market that's showing a lot less volatility these days, a lot more complacency, and it's just one of those things that right around the corner as the year comes to a close, we could see a little bit of that volatility start to pick up.
Well, that was a pretty good preview, Bob, and I appreciate you doing that. But, as we're sitting here, the last full week of trading of September, typically September is it's one of the worst months of the year from a stock price performance, at least historically speaking. We are not seeing that so far. I think we can chalk that up to economic data that's been better than expected. The Fed, surprising to some extent by telegraphing one more potential rate cut this year than the market was looking for. But I got to ask you, Bob, we've had this strong run. The market now is based on RSI levels or relative strength index levels. It's overbought. So where do we go from here, in your opinion?
I think, Chris, traders and investors forget that the market is a discounting mechanism. It discounts news, it discounts prices and earnings out into the future. And I think when most people see a reaction of the market and investors and traders to certain news events, let's call it the Fed, or or its earnings, or maybe it's some tariff news, and when you see the reaction to that, and it's not what the typical response would be, you have to look out into the future that says that the investors and traders are seeing something out forward, 4, 6, 8, 10 months out down the road that is going to be much more significant to what's happening today in the markets than what the news is presenting today. So I think it's important to understand that the market is a forward-looking mechanism. It's not perfect. It's close to perfect, but it's certainly one tool that we could use to see how well the economy is doing and how growth is doing down the road.
All right. So let's take that into account, and I'll do it this way. The market has moved, substantially higher. We've been setting new records, talking about the S&P 500 in particular, and the market multiple has gotten stretched. And, the last I looked earlier this week, it was approaching 25 times current year consensus EPS numbers. And last year in 2024, it peaked at 25.1. So, you would argue that we're pretty close to the top, if we're not at the top from a multiple expansion perspective. So that argues then that we need to see more earnings growth. And that could be one of the things that you're talking about. The market, maybe just given the time of the year, it's starting to think about, how strong could the back half of the year be? What's the prognosis for 2026? Are you starting to see folks focus more on 2026, Bob?
Yes, I do. I think that 2026 and even out to 2027, Chris, is an important marker to take a look at, because when you look at 26, I think you did say that the S&P 500 is trading at about 25 times current earnings, but you would also see that the markets are trading at about 22 and a half times 26 earnings. So while that multiple still seems rather high today, that multiple out in 2026, which we know, of course, is going to be adjusted eventually to upwards or downwards based on the trend in earnings. We know that 22 times earnings is really not all that expensive when you go out a year from now in 2026. So especially with a favorable Federal Reserve right now, which is likely going to be cutting rates probably, I'm going to say four more times between now and next September. So we're going to have much easier policy. We're going to see fixed income investments starting to become a lot more attractive, and in kind that's going to relate to better pricing and better action in the stock market.
Now, Bob, you know how I'm a bloodhound with those consensus EPS numbers for the S&P 500. And you've heard me rail over the years that we've known each other how, for some mythical reason, as we sit here, September, October, the initial expectation for the forward year, in this case 2026, EPS growth tends to be at least 10%, if not higher. As we sit here today, it's around 13%, which is a big uptick from what we're seeing in 2025. And you just said it could be easier policy on the monetary side that helps stimulate the economy. I think everybody would like that, but there are certain pockets, of the market that we're not really seeing demand pick up yet. Housing, for example, right? If we look at a lot of the commodity prices that are tied to housing under pressure, we're seeing companies like Sherwin-Williams actually say that they are rescinding 401k payments because of the weakness in the housing market, and the like. Are you a little more optimistic about housing as we move into 2026 than I might be?
Yeah, certainly. If long interest rates continue to head down, they've been lower. Just a few months ago, we were at about 6%. Now we're close to 5.5%, and going lower. So I think that is going to be a huge catalyst for the housing market. It is certainly going to be a catalyst for the banks and maybe for homeowners to refinance some of these higher interest rates that they've had to absorb or eat for the past 2 or 3 years to get into a new house. So look, I mean, if you're sitting there with a 7% mortgage, Chris, and you have a chance to refinance it down, maybe next year down to 4, you're going to do that absolutely every day of the week and twice on Sunday. So I think that sort of catalyst is going to be huge. I do think that inventory levels for housing and real estate continue to be low, and that is going to be also going to be a catalyst for some of these companies like Lennar and Toll Brothers, who have actually forecasted more inventory coming out into the out years, talking to 27, 28, going down the road. So I do think that the prospects for housing are going to be real strong. I do understand what you said about commodity prices. Lumber prices are heavy. Copper prices are high. Aluminum and steel and a lot of inputs that are used for building houses are up as well too, and not showing any signs of going down. Look at gold. Look at silver. Those things are hitting new all-time high. Well, silver not all-time highs, real close to it. Gold all-time highs. It's signaling that inflation is here to stay and it's not slowing down.
Well, we certainly saw that in the September flash PMI report. Another wave of concern about tariffs and rising input prices. But Bob, I think what kind of jumped out to me in that report was that companies are having a much tougher time passing along some of these fresher price increases. Yeah. This could kind of result in some more tamer inflation numbers, kind of help maybe move the Fed along, as you were talking about earlier. We'll have to wait and see on that front. But I wanted to talk a little bit more about market seasonality because, September, as I mentioned, tends to be kind of a weak month. Historically speaking, but October, November, December, kind of that year-end sprint. Correct me if I'm wrong, it tends to be one of, if not the seasonally strongest time of the year for the market, Bob.
Certainly does, especially if the first 9 months of the year are real strong as they were this year, Chris. And, we're seeing not just strength in large caps, but also strength in the small caps. The small cap Russell 2000 has actually led the markets for the past 2.5 months to the upside. It is actually up close to 9% this year. When you look back in the early part of April, Chris, the Russell 2000 was down about 27% for the year. So it's made an enormous comeback since the lows in the early part of April. And when the small caps are leading, Chris, that tends to lead the rest of the market higher, regardless of whether it's the Mag 7 or it's the AI talk or quantum or whatever the talk may be. These small cap stocks are huge leaders when it comes to the rest of the market, whether it's to the upside or the downside. And right now, the market's bullish. We did actually profile the IWM. Chris, you remember on the weekly roundup last week, it was an important chart to take a look at. And we noted that the candlesticks, which we tend to follow, the color were blue, and on the go, no go composite of indicators, that tells us that the market is bullish. And that has been bullish on the IWM for months and months. And listen, you know what? As a trend follower, as a momentum follower, I'm going to go with what the market is telling me what to do. And if the market is bullish, I'm going to stay bullish too.
So how do you balance that then with, as I said when we first started talking, if you look at just the relative strength index levels, S&P 500, NASDAQ composite, well over 70. How do you sit there and say, I can hold my nose and continue, with the positive momentum? And as you do that, is there anything that you're kind of watching out for, some oscillators or something else?
Yeah, it's not easy, but remember something. Overbought is simply a condition. It's not a signal. And what does that mean? That means that it is an observation that the markets are overbought or oversold, and they could stay that way for a very long period of time. We've seen stocks in this market defy gravity and go up and stay up for a long period of time. And anybody who wants to step in front of a freight train, be my guest, because that thing is going to run you over in a big way. When you got a freight train coming at you at 175 miles an hour, Chris, you're not going to stop it. And that's what this market is doing. And it's making fools of people who are trying to call the top in the market and say that's enough. They just get run over day after day after day. And eventually they're going to be right. But you know what? This isn't a game where it's all about the boy who cried wolf. What it's all about is about identifying the trend and staying with that trend for as long as it goes. Now, to answer your question about what am I looking for to see a shift in that trend, well, you know what? We're gonna see price action become really poor, and we're gonna see heavy volume moves to the downside. We're gonna see lots of characteristics there. There's nothing magical about it. When people are selling on higher volume, well, that's big institutions saying, I'm gonna take my money off the table. I'm going to chips off the table. I'm going to move on.
Right. But to the extent that we have a September that bucks the trend, does that change your outlook for October, November, December? And any particular reason why or why not?
Not in the way that most people think that, we're calling tops here and we're going to come down and test much lower levels. I think that, I hate to say it, that the 200-day moving average is a safe place to find support, but it usually is. I don't think we're going to come down that far. I think with the strong markets that we've had so far, Chris, in nearly 9 months of 2025, I think people are going to want to jump on board. People have missed out. It's that FOMO, fear of missing out, that people are concerned about and worried about. And they're seeing other people making money. We're seeing the S&P 500 up 13% after being down 20 at the beginning of April. It's an enormous move over the past 5.5 months. But still, I think people really want to get on board here. And that is going to be your support. Let's call it a put option underneath the market here by the rest of the crowd who is not in there. That wall of worry has been up high for a long time, Chris. What is the wall of worry? The wall of worry is where people say to themselves, oh, well, I can't get into the market. It's gone up too far. I'm just going to step back and wait. And meanwhile, they continue to watch the market go up and up and up without them. And that wall of worry just continues to get high until people just throw in the towel and say, that's it. I'm done. I got to get back in the market. Usually that's the wrong point in time to do it. But still, I think that as long as the momentum stays strong and it's bullish, we're going to go higher.
So let's talk about where we could go then, right? So we've had some, Wall Street strategists recently bump up their S&P 500 price targets. I think the most recent was Wells Fargo taking it to 6,800. I think there's some others that are out there. I might have seen one close to 7,000. But so let's just game it out, right? So let's say that the Fed does deliver more cuts than the market expects because the economy is, slowing. The job market is a little more concerning, but inflation not as bad. We maybe see a little pickup in housing activity. The AI continues to be strong. Reshoring happens. We see some deregulation. Investment banking activity continues, whether it's IPOs or M&As. Where does Bob Lang see the market potentially heading past 6,800, 6,900?
Well, I think it all depends on where money flows are at, and also the sentiment. Because sentiment continues to be bullish, there really is no calling a spot where people are going to unload, because we flew right through. A lot of people talked about 6,500, Chris, a
Mm-hmm.
couple months ago, saying, okay, well, that's going to be an area where we're going to find a lot of resistance. We went through it like a hot knife through butter.
Right.
There was no resistance at all. So if now if you're going to say, oh well, now it's got to be 7,000. Well, that's a round number. We could slice right through that thing at like a hot, like also like with like a hot knife through butter again, and just continue to go up. So it's really hard to pinpoint an area or a spot where we think the market's going to turn down. I think we just have to look for clues in the volume and the price action and some of the indicators that tell us where it seems like the investors are exhausted and not really willing to put new capital to work.
Okay. So let me come at it slightly differently, right? So we tend to think about, the S&P 500, the market, but as you and I have talked about, many, many times, when we look at the constituents, the big, constituents that are the Mag 7, accounting for a significant percentage, if we start to see sentiment turn on those names, if we start to see those names being, overextended, overheated, and starting to, roll over from price action or something like that, is that a warning sign for you?
Well, we've seen lately, and I referenced the small caps, is that has caused what's called a broadening out of the rally. What is a broadening out of the rally? It means that a lot more groups and sectors are participating, and not just a small concentration of stocks that are driving the action of the market. We saw that last year and a little bit towards the end of 2023,
Mhm.
where it was just a small group of names. It was the Mag 7 and a few other names that were really driving all the action, and everything else was in a bear market certainly back in 23. 24, we saw a few more stocks starting to add to the action. But this year has been interesting, especially since April, Chris, where is again, I've referenced those small cap stocks, and that is a broadening out of the market rally. So when you see days where the markets are down, but the breadth is up 2 to 1, that's the reason why we have that strong breadth, is because of the small cap stocks that are outperforming and catching investors money to invest in those areas. So it's to answer your question. I don't necessarily think that if people stop investing in the Nvidias and the Microsofts and the Apples of the world, in the Mag 7 stocks and the Teslas, that it's going to have a negative effect on the market, because that money that's coming out of those stocks, Chris, is going to find itself in another home, probably in a small cap stocks, maybe the mid cap stocks, but it's going to find themselves in a new spot, but still in the market.
All right. And Bob, you just talked quite a bit about market breadth. What's the go-to indicator for you to really track that?
Well, so market breadth, I look at the oscillators, specifically the McClellan oscillator, which is simply a raw look of the advanced decliner. So it's just basically looking at it not from price action, but number of issues that are advancing versus declining, and that is certainly an interesting point of view for most people. Most people just tend to take a look at the price action alone in isolation, but using oscillators gives us a good feel and an idea of where the momentum of the stock market is at any certain point in time. So the McClellan oscillators, which have been around for 55 years, Sherman and Marion McClellan came out and invented these tools that have been, stood the test of time, certainly since they came out, and it really gives us a good view, a good snapshot of where the market is at a certain point in time.
All right. So, Bob, as we get ready to swan song the September quarter and head into the final push for the year, are there any areas that you're warming up to? Any particular sectors? You already mentioned small caps. Obviously, that's a wide array, but anything more granular that you can share?
So I think the banks, Chris, are a really good spot, and I know we have Bank of America and Morgan Stanley in the portfolio, and those have been stellar names, especially Morgan Stanley, new all time high just recently. And I think that these stocks have much more runway left to go to the end of the year, especially with a favorable Fed and favorable monetary policy, and you've got some deregulation coming up very, very soon. That's going to be extremely helpful for them. It's going to act as a tailwind for their earnings. I'm also like, Chris, I like private equity names like Apollo, Carlyle, CG, KKR is a good one, Blackstone, and then BlackRock to a lesser extent. And then if you look at the periphery of the private equities, Chris, you still have Goldman Sachs and Morgan Stanley representing some of those names as well too. So I think that group right there, along with the banks and maybe some of the regional banks as well too, are going to be huge outperformers into the end of this year.
So the banks I get, right? Again, we do have two in the portfolio, but the angle for private equity, are you just thinking it's because the level of investment banking activity remains robust and they're monetizing their portfolio? Is that the thought?
That's one thought. And then also they benefit from lower interest rates. So the lower interest rate environment is going to be extremely helpful for leverage purposes. A lot of these companies are like Carlyle and Blackstone, well capitalized, so they don't need to borrow too much money. But if they do, and they see an opportunity to add to their portfolios, they can do that. And then also the investment banking community and environment is strong, as you said. Bringing companies out to market, out public, is going to be a huge home run for some of these companies as well too. So this is private equity, when they invest in some of these smaller companies, certainly in the early part of the cycle here, is where this is the payoff for them at the end of the day. They get in at such a low cost, Chris, and then the reward at the end of the day is to bring that company public and to be able to have an ability to sell off some of that stock.
Well, it's funny. I think with private equity, what people tend to forget is it's a different type of investment portfolio. And in order to go out and raise the next portfolio or the next fund, they have to deliver returns to existing shareholders so they can build their track record. It just makes it easier for them to go gather more assets and drive their own fees higher. It's one of those things. All right, Bob. I want to hit one or two more things, and then we're going to talk about something new that you might be doing. But before we get to that, just a couple questions, again, kind of tying into the end of the year. Would you favor, through the end of the year, Walmart or Amazon? Which one?
Boy, that's a tough one,
isn't it?
Yeah, it is. But well, first of all, I'd love to have them both.
But you can't.
You pretty much cover all the bases with both of them. I think at this point in time, I'd like to have Amazon. It's a little bit more diversified than Walmart, and I'm not speaking from the shopping experience,
right?
The shopping experience, because Walmart's online shopping experience is actually very, very good too, and the delivery as well too is almost matching up with Amazon. But I would say that some of the other things that Amazon's getting into, like the NFL, and they're getting into other sports as well too. I think the studio portion of Amazon is a very underrated asset that they have, and I think that they're going to start really monetizing that. And the Amazon Prime membership, much more valuable than anything that Walmart has. Even though Walmart, with their delivery service, and you can sign up for that, it's rather inexpensive. You just don't get the same things that you do with Amazon Prime that you do with the Walmart membership. So I think that is a slight edge to Amazon. Though, again, I'm going to go back to what I said earlier. I would love to have them both.
All right. What about, we know that there tends to be a lot of consumer shopping in the last quarter of the year, the holidays, also, holiday meals and such. What do you think? American Express, Visa?
Oh, American Express, absolutely, because it's in the portfolio.
I thought you were going to say because you don't want to leave home without it, Bob.
I like what American Express has done here with raising prices at the right time. I know a lot of people have balked at that, but I think that what they give you in terms of benefits is second to none. I have as a Chase fan, I have the Chase Sapphire card, and that price is actually going up this year as well too, and they're increasing the benefits. But when I compare apples to oranges here with the apples to apples, I'm sorry, with the Chase Sapphire with the American Express card, I think the American Express card far outweighs the benefits of the Chase Sapphire, and I think you can really make that pay off in a big way. And I think most people, if they do it right, do it well. And I think the travel portion for American Express is huge. I want to say that the last call that they had, Chris, in July, they talked about the growth and the strength in their travel business.
Mm-hmm.
And I
Mm-hmm.
think that that's something that we can look forward to in 2026.
Totally agree. I will also say that they're very different businesses between American Express and Visa, right? Visa, it's really tied to transaction volumes. American Express, about 70% of their pre-tax income comes from membership card fees. So they've continued to grow that the number of cards in force. And as you're talking about the refresh of the platinum card, I mean, if you look at the number of benefits that they're stacking in for a $200 price increase, I mean, it is off the charts. I think some people have tallied it, and for that annual membership, if you use everything, you get like $3,500 plus in terms of benefits. Makes it a no-brainer to me. Last one, Bob, and this one will be controversial, but I'll also give you your choice. NVIDIA against any other chip company out there.
I like NVIDIA a lot here, but the problem is that I think they're priced all the way out for at least 2 years, at least out to 2027, maybe 2028 with their price. So I think that the potential outperformance is just not there anymore. It happened in 2023 and 2024. Stock went bananas, and it rewarded shareholders. They're an innovative company. Don't get me wrong, but I think there's other companies out there like a Broadcom or perhaps American Semiconductor, AMSC, maybe even AMD might be able to catch up a little bit. I'm not an Intel fan. I wouldn't trust them, but I think any other. I think that NVIDIA is going to underperform this year? No, I think they're going to perform extremely well. I just think that there are better companies out there that are going to perform better. Not better companies than NVIDIA, but better performing companies. Their stocks are going to do much better than NVIDIA. I think that Celestica is another company, a semiconductor company that's going to do well. CLS is the symbol. And again, Broadcom is another one. AVGO is one that I think that has a lot of runway left too.
All right. Now, Bob, I don't want to spoil anything, but my understanding is that you might have some news to share about some things you might be contributing to the Street Pro site. Care to spill? Care to spill?
Spoiler alert, right? So, yeah. So I've been talking with some of the management team about adding some new content for readers, and since they know my background is not just technical analysis, but also with options. I have a company called explosiveoptions.net and a service over there. So in the past, Chris, I've written some articles about options and options trading and basics of options. And we're going to start very, very soon talking about some option trade ideas for the readers. And I'm very excited to share some of my thoughts with all of them. And in addition, I think having a good understanding, Chris, of options trading is absolutely essential. And I have some good content that I've put out over the years, some good evergreen content, some stuff that's live today that I've written maybe 5-10 years ago that I'm going to be sharing with the real money crowd as well too, to learn about trading options. Because as Warren Buffett once said, derivatives are like weapons of financial destruction. if you're not careful, you can get hurt real badly. And I think that there's some ways to do it where it can be a benign options trader, or you can be an aggressive one at the same time, trying to achieve better returns for your portfolio than the market. And I think that you can do it in a very safe and secure way. But certainly, I think options give people an advantage. I know you've traded options in the past, and
Yeah, I know I have.
you've done
But
really
but
well. But
but you're much more adept at this than I am. I was arguably probably doing a little more than dabbling. But from your perspective, Bob, there's a lot of moving pieces to options. You really have to watch it. But what's the one or two most common mistakes that you see new options folks make?
Well, I think it's managing risk, Chris. I think people don't really understand how to manage risk properly, and they think that most people think that they can hit a home run every single time they step up to the plate. And for using a baseball analogy, and who tries to hit a home run? I don't think anybody. I don't think even baseball players try to swing for the fences whenever they step up to the plate. I think option traders have to have the same mindset. You have to go try and hit singles and doubles, and all those more singles and doubles can add up to you can score a lot of runs by keeping your players on base. So I think it's managing risk is the important part. And a lot of people I've come across many of them over the years, Chris. They go all in. They trade with too much size. They don't take their money off the table. They don't cash in their wins. They don't manage their losses properly. And it all ends up being a recipe for disaster, because you have to follow some rules and you have to follow some protocol here in order to make money in the options market. Because believe me, there's nobody who's going to forgive you for making a mistake. You're just going to lose money, and you're going to have to learn from it.
Excellent, Bob. I think I as well as everybody else listening to the podcast is going to look forward to that content. It sounds like it's going to be very exciting, and I really can't wait to see it get started.
Looking forward to sharing it with everyone.
Excellent. Bob, before we get out of here, any parting thoughts as we wrap up the month of September?
Well, as we wrap up the month of September, wishing everyone a Lashana Tova, Happy New Year for all of our Jewish people in the tribe. You too, Chris. Lashana Tova, wishing you a year of goodness. And as we head into the end of the month and the quarter, Chris, it's going to be interesting to see how we finish up, because we are up for the third quarter here, reflecting some really good positive trends. And I think I want to say that it's interesting how the stock market is up this third quarter, and the GDP estimate is somewhat close to 3% for the third quarter. Is that about right?
As we sit here today, depending on how you're looking at, Atlanta Fed GDP now is around a little over 3%. New York Fed, I think, is still around 2.1.
Yeah. So, I mean, we're looking for a real positive quarter. We'll see those first numbers, Chris, coming out towards the end of the third week of October, the first estimate. And earnings season coming up in a couple more weeks. It's going to be real fascinating, being real interesting to see what these companies have to say as we end the year.
For sure. But Bob, that just means you'll have to be back during the fourth quarter so we can wrap it all up. And with that, folks, that is Bob Lang. Check out all his content over at TheStreet Pro, both technical analysis for the portfolio, and you heard it straight from the man himself. Soon, some nice options content as well. As far as the podcast goes, folks, that's our episode for this week. Thank you so much for tuning in. We'll be back before you know it.